Wednesday, oil.
Wednesday,
right?
oil. So it's 10:22 right now. We get those EIA numbers every Wednesday at 10:30 a.m. Eastern Time. Pulling up the oil contract. We're looking at the June contract, currently trading $70.71. Okay. So I jumped in to begin with, and let's take a look at maybe setting up a volatility trade like we do. Like we like to do. So we'll look at both sides of the market. Here's a bullish spread. I started with the 11 a.m., so these expire at 11 a.m.
Yeah.
We get the news at 10:30, so this will give us pretty much the shortest time frame possible with the news in play. And so all of these contracts are going to line up with 71 being your pivot point, where you can have maybe a bullish spread on one side, a bearish spread on the other, and you're looking for volatility. Now, you can always take one side of that trade if you just want to have a market bias. But what's going to happen here is that if you're taking both sides of these trades, you're going to have a little bit of a bearish bias in that you have intrinsic value on this bearish spread to the tune of almost 26 cents, right?
Yeah.
So here would be our bullish spread. That's going to be out of the money. It's going to be all premium. That's going to be the cheap leg. Here's going to be your expensive leg, and that's because you're paying 27 cents automatically in intrinsic value, and then you're adding on about 9 cents in premium. So this becomes a little bit expensive if you're just looking for pure volatility.
Yes.
Because you have to pay for that intrinsic
We're at
value.
47 bucks, right? Yeah, 47 cents to $47. Okay.
Yeah. Now, if you had a little bearish bias, that might be a nice trade because, you know, to break even, you only need to trade $46, 46 pennies below 71.
Right.
And you're already 28 pennies below it. And
Yep.
if, you know, you have some type of explosion to the upside, you still have exposure. But this takes upon like a little bit of a different angle than we normally like to look at, where if it's just trading at $71, you're just able to trade straight premium on each side.
Yes.
So that was our 11 a.m.s. Let's jump to the 12 o'clocks.
Okay.
So these go from 10 till 12.
Yeah.
We're going to be dealing with identical prices.
Same number, which is pretty cool.
Yeah. So on the positive side, instead of $10, it's going to be 13. And then on the negative side, instead of about 36, it's going to be about 39. So we're looking at about $52 for the noon trade.
Yep.
And again, same exact prices, same exact $1.50 spreads in either direction.
For $5.
Just an extra hour.
Right.
And then to stretch things out a little bit further, if we jump to 71 to 74 for the 230s, now these are $3 spreads instead of $1.50. But realistically, a lot of the premium being added is for that extra 2.5 hours trading from until 2:30. So your bullish spread becomes $17, and your bearish spread becomes $46. So you're looking at about $63 for your for your 230 trade, with $3 of potential. And just to reiterate too, and you jump down to this is what's always interesting. You jump down to the dailies where the $5 spreads are.
Okay.
And this is if you were going to make these 230 spreads instead of taking the daily ones that start at 8 a.m.
Right.
You'd probably be better off trading the ones that are the $5 because look at the market, they're identical.
Yeah.
Okay. So you know, you're not paying anything more, and if you get a break in one side, you have $5 instead of $3, so a cent. So again, you know, lining this up, there's your bullish spread 71 to 76. There's your bearish spread 71 to 66, and we're talking about basically identical prices, paying about $63, $62, same deal for your
because it just moved a little.
Yeah.
That's pretty cool.
Yeah.
I mean, when you think about it, and that's important to understand, folks, when you're doing any of these. Okay.
Yeah.
If you're going to pay the same amount and you have a larger spread, well, take it.
Yeah.
Yeah.
Exactly. Basically, the market is assigning no extra premium.
Right.
For $5 of ability versus $3 of ability. And the reason why, the fundamental basis, just to understand, you say, well, why are they doing that? You know, why can you get $5 of potential movement without paying any extra premium? And it's like, well, because realistically, there's very little, almost zero chance that oil moves more than $3 prior to 230. But the reason why I say is almost very little, right? I mean, it's not 0% chance. So if they're charging you $0 extra and there's greater than a 0% chance that you might be able to profit off of that, why would you not take it, right?
Totally.
So we'll see what happens. We got 3 minutes till those numbers come out. Oil trading $70.77.
Stay right there, folks. Tommy and I are going to be coming right back. We have the Dow right now up 29, NASDAQ up 28, S&P's up 8. Come right back. Welcome back, folks. So crude inventories fell 1.4 million barrels.
Yeah, and to clue in the expectation, Bloomberg users were expecting a rise of 1.1. So a bit of a miss. We'll pull up and jump back to the NADEX platform. And on that news, you have oil
Look at that pop.
Fading higher. Quite a pop, man. We were down there at $70 and call it 75 cents, maybe really 70, and we got about a 45 cent pop to the upside. Now, this is where it's important to note, and that's why we stressed it, where it wasn't quite an even volatility trade today, right? If you were going to take this trade, you were looking for potentially the easiest way to become profitable was to move downward, right? Because all of the spreads we were dealing with started at $71. If you were taking both legs of that, you needed... it was easier to break even to the downside because, you know, whether it was 40, call it, let's say 50 cents of movement you needed on any of the contracts, at least you were talking about 50 cents away from 71. Right. So right now, any of those trades, if you were taking both legs, your max loss would have been at $71. And so you can see how you get a decent move, you get 40 to 50 cents movement initially, and really you're getting in the wrong direction though, right? That's where it becomes difficult. Now, you know, the other side of that though is that you could have just taken, let's say you thought oil was going to pop. Let's say you thought there was going to be a miss. The bullish spreads, because they were out of the money, you have broken even, which is interesting. So if you had just purchased the bullish spread, those were hovering around 71.10,
cheap money.
71.10. So that's where you can see, okay, you know, maybe if you just taken the bullish side, you could have gotten a pop, and already you're at break even, let alone you're only putting up $10, 10 cents above 71. And so, you know, if you start getting some serious moves, that's where you're making 2 times, 3 times, 4 times on your money. So a little bit of a miss. Maybe higher oil prices could be in store. We'll see. But as we know, the first move is not always the move that carries out. And we'll see if that goes back. Let's just jump back. I'm interested to see. There's the breakdown. So the median estimate was even bigger than the Bloomberg estimate in terms of a decline of about 2 million barrels they were looking. Now, that's interesting because that's talking about a decline versus Bloomberg users were looking for a rise. So maybe the miss wasn't as big as they thought in terms of, but interesting how maybe that was an update where you get the median estimate, that's the analyst's estimate versus just a Bloomberg user survey. PADD 3 crude down about 1.5 million. Gasoline, pretty big miss as well, declining 3.8 million barrels. Estimate was only about 1.4. Distillates, barely off versus the decline, looking for about almost 2 million barrels. Yeah, so they talk about demand, always interesting. Fuel demand falling 1.1% in the past 4 weeks. Ethanol stockpiles falling, ethanol output rising. And to jump back one more time, so look at that. Yeah, crude exports rising to quite a graph in terms of our exports rising, surpassing 2.5 million barrels a day for the first time since the ban was lifted last week. Cheap Texas crude is definitely helping. Cheap Texas crude.
Yeah, compared to Brent. Because someone had called yesterday and said Brent was almost trading. Oh, no, I was talking to Andy. He said Brent was almost at $80.
Interesting.
And so that's in Europe.
That's amazing.
Yeah, it really
quite
is.
A number, $80, yeah. So, right at $71, that would have been a max loss situation if you were buying that volatility, but we're getting some volatility right now, so we'll check back into the hour, see where we are. So let's check back in on oil one more time.
Oh, look at that.
Yeah, so we're up at $71.33, back down to $70.96. So approaching that $71 point, which is, you know, the max loss if you had traded both sides of that trade. But like we always talk about, you could have been trading the 11 a.m. expirations, the 12 expirations.
12 is $52.
The 2:30 expirations.
Plus your commission, you know.
Yeah. So a little bit of volatility. We'll see where it shakes out. Not too big of a miss, but the market kind of just not too big of a reaction in general.
And that, you know, that's why you want to look at the different time frames also.
Yeah, because depending what your market bias is, all that stuff, right? For sure.